All right, thank you very much. We'll start the session. Today's title, the area that we are going to talk within the strategic management accounting is managing corporate value. I'll try my level best to keep on explaining the concepts instead of asking questions from you guys, since the context or the ambient does not seem that you would be answering. So therefore, I will keep on continuing my explanation. However, you are free at any point in time. If you have a doubt or if you need any explanation, feel free to stop me and ask a question. So you have several options. One is to unmute your mic and you can disturb me and ask questions. So there's no problem, need not to take any permission. You can straight away ask questions just by unmuting your mic. Number two, you can leave a question in the chat box, but sometimes I may see it or may see it later. However, I will look at the messages in the chat box as well. The other one is you can use the raise hand option. Then I can give you the opportunity to ask questions. A corporate value. So yeah, the word corporate, I know that you have been using this particular word most of the cases: corporate accounting, corporate reporting, corporate taxation, corporate value, and all those things. What is the meaning of this word really? When we live in a world, actually we are individuals. So therefore we do things for individuals would try to do their own things, satisfy their own things. So you earn by yourself. So individual base, earnings, eating, sleeping, or whatever, all the actions are considered to great extent. So not only humans, even other animals' actions are, as long as the maintenance of the human life or their lives are concerned, that is individual actions. Even the value creation or whatever. So you can generate value, but limitations are there. Lots of limitations are there. The success to great extent depends on collective actions. This is why and how societies have been developed up to this particular level, and humans are controlling other animals and the planet because of the collective actions, even though we do not admire that that is a result of collective action. Rather, we claim that that is an individual action. No, it is not an individual action. So they can do very little. The word corporate is the collectivism, together. If you do something together, it is a corporation. So Sri Lanka as a country, we need to just talk about Sri Lanka from that particular perspective. That is the collectivism. So even politics and any other things, if you really want to develop the country, we need to look at Sri Lanka from that particular perspective, instead of looking at your individual perspective, your own wishes and whims and fancies, your nationalities, religion. So now you can understand why we are not developing, because we have been dealing with such kind of individual perspectives. Even we hand over the future of the country to individual visions and all. So at the end, so those individuals really turn the country to real mess and political turmoil. So however it is, the corporate value can be, or the corporate can be seen from such a broader perspective as a country or as a society. If you talk about the society, that is also corporate. Now, when it comes to mode of production in a country or in a society, what do we need to have our lives just to live in a society? We need goods and services. We need to produce them. There are certain goods we can simply extract from the nature. You can catch fish, you can pluck some fruits, so there are certain things, so you can dig the soil and find something for your eating or survival. There are certain things, they are very primitive and limited. But when it comes to mass scale production, um, to develop a country, you need to have a kind of production. That is what we call mode of production, production of goods and services. How can we produce goods and services that we want? That we, in the sense, we refer to Sri Lanka. Sri Lanka or Sri Lankan society, country. How do we do that? It could be done in many ways. If you want, you can individually produce. Some people do that. You manufacture, you produce something at home, you satisfy your things at home. If you want, you can manufacture things as a sole proprietor. Even employees and others engage. The initiation of the production process starts with individuals, but individuals, so the individuals cannot continue the production process, where employees and other stakeholders will have to engage in that production process. But it can happen at that minor or tiny level. So simple grassroots level mode of productions where only very few engage in. When it comes to business form, maybe sole proprietorship, even without having a registered business, individuals may do certain things for their livings. If you go to countryside, rural areas, they may do certain things in the fishing area, farming areas, whatever. So sometimes those small productions may be seen at household level. So that's the most the primitive and smallest structure of the mode of production. Even though the cooperation is there, cooperation of other stakeholders are there, the ownership of such production mode is with only individual, one or two. When it is more than two or more, it becomes a partnership. Likewise, different forms of organization you may have heard. But you know that there are limitations, lots of limitations and obstacles are there when you engage in the production process as a sole proprietor or partnership or any other forms compared to a limited liability company. If you form a limited liability company, you are relieved from many things. You are relieved from unnecessary liabilities. You are given lots of freedom to engage in that business activity, those activities without having any stress. Again, it creates an opportunity for many people to work together. You can pool your capital together. Pooling of capital takes place in terms of share capital. So you invest your money in shares. Therefore, in the first place, when you form a limited liability company, there is a cooperation. For what? Cooperation to form capital. Capital formulation is the cooperation. So you do it cooperatively. You do it together, collectively. Then you have funds together. Funds belongs to shareholders together in one pool. That fund, finally, we call investment of the investors that goes to the business. Then the business can make use such funds to create value. Therefore, depending on the nature of the business, the managers of the business utilize such funds to generate cash flows. Eventually, they become revenue, and finally, that ends up with profit or rather value. So, like, So that particular process, I mean, the mode of production, it happens collectively. So don't get it confused. Any production process has a collective effort, but here, why it is corporate legally, the entire process is like when starting from the capital formation, it's collective. In the case of sole proprietorship, capital is individual. Partnership, capital is just from two or more partners. But many may involve in the production process. That is the cooperation in the production process. But when it comes to limited liability company, formation of capital is also corporate. Decision making is also for corporate. Managers take decision on behalf of you, is corporate. Then profit is generated. That profit is also shared by shareholders. That is also corporate. So that's why whatever the things that you do within a limited liability company is cooperative, collective. Now I think you got the idea. If you have any doubt, please ask. So now we are trying to manage its value together, not as a single shareholder or investor. Therefore, now you must understand the fact that that would not be that much easy. However, we have created a mechanism. Even though this is a corporate value or managing corporate value, those who want to have the value created within the entity are not the people who really engage in the business process. You become owners, you want to manage your wealth, create value together, but that task is given to, handed over to so-called managers. So that is the separation. Agency, this is how the agency is created. In a way, had you started just creating value together as investors, of course, situation would have been real turmoil. Now you have a solution, you have managers, good corporate governance mechanism, and managers do things on behalf of you. That's why managers become your agents of shareholders. So that idea is very important for you to understand the concept managing corporate value. What is meant by managing corporate value? We are going to discuss about the meaning of value, what is really meant by value, strategic value analysis, and value drivers, what really drives value. Then the firm's value, firm here, firm refers to limit, it could be any, but mainly we refer to a limited liability company. Limited liability company can be in the form of public company, private company, listed, multinational, ultranational, likewise, or cartel. It could be any different forms. Its proposition, before coming, that strategic value analysis and value drivers, we will be talking about meaning of value, then strategic value analysis and value drivers, what is really meant by value analysis, and what really creates value, that is the drivers. Then firm's value from its proposition, value chain. We will explain how value is connected through a chain. It's a fact that everyone knows that now products cannot be developed with one single action. Unless you pluck something, some fruit from a tree, one action is finished. You pluck something and eat it. So value chain ends. You collect that particular, pick that particular fruit and ate it, finish. So, but if you want, you can use those fruits to prepare fruit salad if you want, or you can think of some other products. You can nicely pack them, dehydrate, and even you can think of export market. So therefore, depending on the nature of the product and depending on the structure of the production process, value may differ from one stage to the other. In other words, value is generated depending on the action and how it is connected to this particular chain. That is why we refer to a value chain. If you pluck fruit or vegetable and continues it with the market process, and finally export market with a value-added product, so it takes longer time period, but you understand how long it is. So value chain is long. You simply pluck some fruits and sell just along the street, the value chain is very short. If you pluck and eat, so very short, quick matter of so they're like, you are the buyer, seller, and the value creator, so only single person. I hope it's clear to you. Try to understand from that particular perspective. So now we talk about these kind of complex productions. Instead of dealing with primary producers, when we think of high sophisticated electronic equipments, such as lots of items in IT industry, technology, science, equipment, even the most advanced equipment. Nowadays, we talk about 3D printing. 3D printing cannot happen overnight, like it engages in so many different processes and connected to a technology. So who has this particular technology? We may learn about 3D printing and uses of 3D printing. 3D printing, we learn that 3D printing can solve lots of problems. Even body parts, human body parts can be printed. But have you ever experienced this thing? Suppose that you have lost maybe part of your arm or limb or whatever. So it is possible to print it now. So in case, imagine that you lose your maybe part of your body, can you easily print and replace your body? Though the technology is there, it's like a dream. Why? Though the technology is there, technology is not with you. Technology, so you are not in a position to afford for it. Technology is with only the handful of people. They determines to whom it could be accessed. I mean, whom it could be accessed, who would get the benefits, right? So even if you think of the health facilities, when you are born in any society, if your health is not taken care by the society, especially like in the case of this pandemic situation. So what nice stories about 3D printing. So you can talk about these things only in textbooks and lecture theaters only. You will never ever realize them until and unless the the mode of production would be rearranged whereby the benefits are transferred to the hands of everyone if you are entitled. So actually learning happens if you questions only. You try to understand these complexities. So the firm's value proposition or the chain, what I just want to tell you, it could be very simple and could be very complex. That's it. When we talk about, or from learning point of view, global point of view, value generation point of view, we need to think of the most possible lengthy, complex value chains. They exist in the world, no matter, right, who are benefited from these things, but they exist. The 3D printing or any other sophisticated machines to great extent. Nowadays, if you take a single item, for example, devices such as Apple iPhone or any other devices, though they are said to be manufactured in one place, the world, the components are manufactured at different places. So if you carefully analyze how it is manufactured, how the value is added on to that particular product, values may be coming from different sources, different places of this planet. So keeping that complexity, we try to understand real business processes, simplest and the complex ones. Value identification, that's also very important concept. So what is really meant by, next slide I will discuss. We need to identify what's really meant by value. Value could exist in different forms. Sometimes value may disguise itself and appear in front of us as something which has been generated. Big question mark arises whether it is created or generated or real value is there. For example, value identification, say you have a company to manufacture some, say the fisheries industry, you catch fish and you have a canned fish factory, then there is a process of cleaning this fish and lots of kind of scientific processes may be there. Finally, fish would be put into a can. Then the canned fish that goes to the market, again logistics arrangement, to wholesale, retail, finally consumer just consumes fish. That is a production. What is the ultimate value? Whatever, say 300 rupees, it is something under different situation, like in a highly inflationary situation, sometimes fish can may be sold at 500, 1000, we never know, in case if the country would face hyperinflation in the future, like in Turkey nowadays. So Turkey is a country, we are now newest country which experiences the bad lessons for the bad governance with high inflation. In case inflation goes up, that may go up. But however it is, there is something. You see canned fish. Canned fish. Irrespective of the question, how that value or the price is distributed among those who really generated the value. If you take a product, some artificial product, maybe an index. So nowadays you guys may have heard about token trading, token exchanges, even cryptocurrencies, shares, any other derivatives, options, hedging, forward contracts, and indexes such as fuel indexes. You can buy. There could be advantages and disadvantages. For example, if you think of fuel, last year or so, the price was almost zero or 20 something, but at the time of delivery, some people just disposed at a price which is highly less than the price that they bought, by incurring a negative, that is a loss to them. That is why sometimes analysts interpreted it as a negative. Oil barrels were sold at negative price. So it doesn't mean that whenever you bought an oil barrel, you were paid some money, so because you bought all those indexes, and those who did not have adequate storage facilities happen to sell at a loss by incurring, so just driving that to a negative price. But I'm just telling you, because you are in the final year student and you must be in touch with these things. By that time, really, had the government bought, because being a government can store oil. We have a large number of oil tanks in Trincomalee. Had government taken a decision to buy oil at a very low price, maybe low indexes, even at a low prices, negative prices, where you get gain as well. They store them by that time just for 1 year. Of course, again, another question arises whether we had enough dollars to do that. No, we didn't. We, even with the amount of reserves that we had, if the government wanted, government could have thought of such kind of strategies. So what I'm just trying to tell you, when it comes to these kind of products, trading indexes, shares, and derivatives, actual product, there would be an underlying asset. In the case of oil barrel, what you are buying is not the oil barrel, but you are buying the index. In the case of shares, you are buying shares. That means the value of the company. So share is in a way, of course, it is not fictitious, but it is not seen. So value could be easily inflated even if there is no value. If the real value of share is 50 rupees, based on the fundamental analysis, that's all right. Why do you buy at 50? Because there is a value, but you know that it could be speculated, like what happens, what's happening nowadays in the stock market, Colombo stock market, stock exchange as of now. Quickly, within a day, share prices go up by 20%, 50%. Likewise, fluctuations can be seen. Why? Is it because of the real value embedded in those shares? No, mainly because of this speculation, demands and supply. So some manipulations are also there. So what I'm trying to tell you is, so that value has to be separately identified. What the real value generation there? Is it a value generation or just sniffing, like snatching some value from one place to the another? If you engage in corrupt transaction, you supply goods and services to the government through unsolicited bidding process. Real price is just 500 rupees. You can sell that particular item at 1,000 or 2,000. You can earn quick bucks. You can get quick commissions. In the business context, it is a value. So that value is, of course, once you have accrued something in terms of profit, it's a value to you, but you need to distinguish these things from real value generated within business enterprises. So otherwise that might lead to confusion, because you have to have that particular understanding. That is why value identification is important for us, right? Now, by this point, now I will explain all those things later. You must realize that value could exist in different forms at different stages. Then the relationship between value formulation and business value within a firm or business entity, we have to discuss about how this particular value is generated and created, and interconnectedness. When we talk about those things, we simply disregard its identification because we feel like it's value. But you know that value may come from real business or manufacturing process, or through speculation, or any other, even unethical practices may be there. However, you know, in the business world, lots of unethical practices, corruption, frauds, lots of things are there. Even from all those things, you can create value. But here we discuss, we interpret value not with that meaning. We interpret value with the meaning that it is generated through authenticated business processes in an ethical manner. It is not fraudulent. It is not from a fraudulent source, right? So with that understanding, we discuss about this thing. But practically, value could be amazed through undue, unethical, immoral sources. This is what we are experiencing in Sri Lanka. The triangular relationship among strategic drivers, value drivers, and creating value identification. The same thing is just how it is connected. And finally, the business valuation of a firm by using discounted cash flow technique. You have already learned discounted cash flow technique, I suppose. Here, I'm not going to teach you in detail about basic principles of discounted cash flow techniques, but here I'm going to apply it with it's not really modification, but with extensive explanation how the cash flows are estimated. Under normal circumstances in finance or accounting or project evaluation, you are given cash flows, you are given some information to determine the discount rate and all, then you simply discount it. But here, what most matters are determination of cash flows, accuracy of cash flows, how best you analyze and estimate cash flows, and how accurately you determine discount rate. So they are the biggest challenges for us. We will be discussing all those things and finally do the valuations as well to get some sort of understanding. This business valuation does not simply mean that simple discounting, but the discounting values which are embedded with values influenced by other non-financial factors as well. So this is how the agenda has been explained. The last part, valuation, would be discussed next week. All right. So for any question? If you have any question, you can ask. We have spoiled your day, right? Because 24th Christmas Eve, you could have gone for parties. We have spoiled, don't know. So anyway, so I won't take long. Maybe by 8:15 I will stop, because two groups will have to make their presentation as well today at 8:45. Don't blame me about this presentation fixed on 24th night. Do you have any question? Right, then I'll proceed. What's meant by value? Is it unique? Something unique? Is it equal to the price? Is the value created or generated? How is it formed? So spelling mistake there. Formed through business operation? How is it shared among those who generated it? Lots of questions are there. We'll answer to each question one by one. Is it unique? Actually, value is not unique. It may exist in different forms. Mostly used values when it comes to some assets like shares or any other financial assets, we can deal with intrinsic value. Intrinsic value is value embedded in that particular asset. Value embedded. That means that's there, you can take it out, either by using it, consuming it, or like using in any production process, whatever it is. That is what is called intrinsic value, embedded value. Really, the amount in terms of goods and services or financial values embedded in that item, it's called intrinsic value. Then when we talk about intrinsic value, that is objective, really. There could be subjective values as well. You can place subjective value. When we have subjective value, your judgment is there, personal judgment. Sometimes you may value locally produced goods more than imported one. So that is your perception, your emotion, subjective valuation. You might think that the product with that particular brand has high value, high quality. Then you may place high value. There is a value. So sometimes social prestige. If you use this particular product, you may feel like I have a social prestige. Yes, of course, in some societies like Sri Lanka, if you have lots of money, lots of wealth, and a highly materialistic person, so you can behave like a god. Other people really worship you, especially when you go to countryside. If you have a big vehicle, big house, gold and all things, if you are rich, super rich, ultra rich, you are treated as a god. So that could be one of the reasons why people amass lots of wealth, either by hook or crook. At the end of the day, you become a god. So that is different forms of values. Um, Emotional valuation would be there. That is also subjective. Subjective valuation has two parts. One is this emotional value. The other one is the professional judgmental value. Sometimes some valuers um, of shares or valuers of businesses, professional valuers also can value. They follow some rules, techniques which are accepted or benchmarks, but of course, kind of judgment, professional judgment may be there. So whenever you use professional judgment, variations between or among professional judgment should not be that much significant, like in the case of emotional judgmental valuation. So that difference. Another difference in the value would be exchange value. When you exchange something in the market, that is exchange value. So exchange value is connected to the price. Even without having a price, you can exchange one commodity with another commodity. You import goods and with exchange them with exported goods. You give some goods to other countries and import goods from another countries. We forget about the in dollar involvement. It is an exchange of goods. Exchange of goods. So that is exchange value. Then you decide how many garments are exchanged with one iPhone. That is the exchange value. If it is 10, 10 is to 1. That is the exchange value. One iPhone is equivalent to 10 garments. So these things are measured what we call terms of trade in economics. I hope you must have already learned these things. Terms of trade, imports, export, the prices are considered in that way. Exchange value. Even exchange value can be seen in other marketplaces as well. You go to the market and buy the things. You exchange your money with the goods. Then there is a price. What is the price of a 1 liter of gasoline? Price of a bread? Price of any other thing? So therefore, when some cases this exchange value is connected to price. If the market is efficient, a price may reflect the intrinsic value, but not necessarily. When there is a very high inflation, intrinsic value would be very little, but you will have to pay very high price in order to buy it because of the inflation. Then inflation distorts this. Then what you have to understand that price is not equivalent to value. Price is going to be equivalent to value only in the case of exchange value, and it is identical when the markets are highly efficient. Otherwise, price is different from value. That is why we have to do the valuation. If both are same, we need not to do any valuation. That exchange value. There is another value called embedded value, that is the intrinsic value, exchange value, and use value. There is another value called use value. In accounting, you must have already heard about. Use value is the value that could be generated by using that particular asset. Suppose that there are two computers. You and I bought similar identical computers, 500,000 each. I use it for BPO businesses. You use it for cryptocurrency mining. So we both use the similar asset for totally two different purposes. The cash flows that you expect In the case of cryptocurrency mining, you can't all the time, you need to dedicate your computer for that particular process, whereby you would expect something. So that's your cash flow. That would be totally different from the computer that I'm going to use it for BPO operations. And I also get it. So when it comes to the use value, as far as the market value, price is concerned 500,000. But if you want to measure the use value, you need to ascertain your cash flows in that way. From mining, how much are you going to earn in the future? From BPO, how much I'm going to get in the future? Then discount them and get the net present value. Net present value would be the value in use. So those are the common values. Apart from that, there could be other modes of values as well. What I want to tell you simply, if I summarize the meaning of value, value could exist in so many different forms, and the value is not as the same as the price, but the value can be equivalent to price if the markets are efficient, and when the value that we refer is the exchange value, then the price is equivalent to the value. Other than that, value could be a different concept. Value is created or generated. No matter whether we use the word the creating or generating, but there is a slight difference when we use the word creating, because the creation is something magical, like you can create it. It's not there. For example, you simply buy something, or you mediate in a transaction and get a commission. It's not a creation, it's simply a generation. But in the business world, these two words are interchangeably used with the same meaning, created, or the creation, and generation, but with the same meaning. Actually, the meaning is value generation. So argument is that when we use the word creation, somebody may argue that, yeah, you can create it at any point in time and any amount. No, it's not. So therefore, most appropriate word is not the creation, but the generation. Generation how? From economic activities, operating activities. Your real operationalization should create value, or generate the value, and not from any other things. Therefore, the value generation is connected to the next point through business operations. That's where we separate operating activities from other two activities, financing and investing activities. Now you can understand that how important the operating activities are. Operating activities are connected to value generation, the value creation of an entity. Then the last point is, how is it shared among those who generated it? So this is a big problematic and controversial area. In this session also, I'm not going to discuss in detail, because it leads to sociology and political sciences. Lots of arguments are there. But if you consider the present business environment within which we live in, actually the value generated through business operation is not fairly distributed. That is the simple conclusion. A significant portion of the value is amassed in the hand of the few, and insignificant portion of the value is distributed among large number of stakeholders, those who contribute to create the value. So this is how social inequalities or inequality in income distribution takes place. So nowadays there are lots of statements and arguments and say that we live in a world where income inequality is increasing. In the United States itself, if you take the richest 10 people whose wealth is bigger than 50% of the US population. In Sri Lanka, the top 10% of the population gets 35% of the GDP. Top 20% gets more than 50%. So such a huge income inequality exists everywhere. It's not good for the mankind, not good for the society. It creates lots of inequality in income distribution. You can see these inequality issues and the wrong mode of productions creates lots of problems in the society where many people would struggle to live in some or other ways. They are connected to lots of problems, either borrowing or any other things, and you struggle. This scenario is very nicely explained in the Korean TV series called Squid Game. If you have not seen it, I think you must have come across this series. Very interesting TV series. It has a relevance for you guys because it's connected to this neoliberal economic policies and this the present situation that we are facing. Some or other way it is connected to finance and greedy financing, neoliberal policies and profit maximization objectives, and how cruel they are vividly explained in that TV series. If you are interested in, please watch it, but it takes time, more than 9 hours. I happen to continue to watch it from the 3rd episode to the last one. So such a curiosity is also there. Please watch it, then you learn a lot. Now, we move on to strategic value analysis. The underpinnings or the premise of strategic value analysis. Now, up to now, I was explaining you the simple value, meaning of value, how value exists in different form. Please excuse me. Right. Sorry for the disturbance. What I was explaining you was the value, different forms, how it exists. All of a sudden, a new word comes into the picture, strategic value analysis. Value, we are going to analyze. So analysis, of course, deals with the stages, processes, actions, or any other arrangements which add to the value of a given commodity step by step. We need to analyze. So analysis helps you to understand the places at which the value is generated and how much, what is the cost of that, whether it is worth or not. So likewise, lots of information can be generated if you do, when you do the value analysis. Why is it called strategic value analysis? So strategy, the word strategy is like a double-edged sword. It's like a double-edged sword. It's dangerous. You got to use it carefully. Strategic value, so the strategy or strategic, that particular adjective is used with the mentality of competition. Mentality of competition. When we explain businesses, we believe and we argue that business operations take place in competitive markets. Fair competition is there, democracy is there, anybody can enter into businesses. Like in perfectly competitive markets, you learn that no buyer, no seller can influence the price. Anybody can exit and enter into the market whenever they want. So many nice stories, right? Then you compete with others for what? Of course, to maximize your own utility in a competitive, democratic manner, fair manner. So whereby that particular competition, so this argument, that particular competition will helps reduces the cost of production because you comes out with new innovation, new ways of doing things, that and this. So nice. Price goes down with high efficiency. So that is why theoretically the equilibrium price in a perfectly competitive market is regarded as the most efficient and fair price, but that never exists. You don't see it. You can't find it. So anyway, the strategic, you need to be strategic when you think of that particular perspective. Of course, if you analyze the business operations in the past, especially after 1970s, 70s, 80s, 90s, to like especially until the global financial crisis, to great extent, this competition works, but the competition slowly starting from 2000, the 21st century, started to move towards some other different space territory. That is no more competition. You may see the competition nominally, but in substance, there is no more competition. You see oligarchies and monopolies. Only handful of people are controlling the business, depending on the situation. If you take the entire globe, world, only 10, 20, maybe 50 companies are controlling. Tech giant, Apple, Google, Amazon, Tesla, that is electronic manufacturing likewise. Mainly tech giants are controlling. Who has the 3D printing? Not everyone, only very few companies, the global scenario. If you go to a particular country, within that country also, the major part of businesses are handled by only a handful. If, for example, if you take Sri Lanka, who controls the trial industry? Who controls the pharmaceutical industry? Who controls the rice? Who has the access or the controlling power in the agricultural produces? Of course, there are thousands and for the thousands and tens and thousands of farmers engage in farming, but finally, value would be taken from accumulated in the hands of very few everywhere. So you better read and try to understand. So therefore, today's learning from strategic value analysis or the meaning of strategy has to be questioned by asking a question up to what extent it is valid as of now. In many textbooks, many courses, many examinations, including professionals. So we learn these strategies with that mentality. That's all right if the that context is highly competing, but we are not living in such a competing situation. It's a distorted environment whereby we need to think of alternative value analysis as well. So those things are discussed in other countries, but not in Sri Lanka as of now in our modules. But anyhow, we need to think of. Anyway, towards the end of this session, not today's, next week, I will explain you, or I'll just show you different modes of organizational structures, different modes of value analysis, different discussion about strategy. It doesn't mean strategic value analysis or strategy is irrelevant. It is relevant. You need to have strategies, but for common prosperity and not for individual prosperities anymore. If you continue with that, that might create its own problems. So that is very basic foundation. With that, I will continue. So here and after, I use the strategy with that particular perspective, competitive perspective. Okay. Value formation depends on industry value chain. So each industry can be identified with a particular value chain. Sri Lanka, you can take agricultural industry, yeah, fisheries industry, or manufacturing. So you can take any. Then you see the value chain industry. Some chains are very short, some chains are lengthy. Some chains are short, some chains are lengthy. As I just told you, you grow something in a very small scale, bring the harvest into the village fair and sell them. So the value chain is short. But the same farmers work together as a cooperative, and the bulk of the production produces, and they produce based on information technology, depending or by responding to the local demand and international demand, and they take decision, they change the cultivation methods, the use of fertilizer and use of technology in farming and all these things. And again, if they can connect to wholesale markets in Sri Lanka, or if they can connect to global markets with value-added products. So the same farmers can link to a global market. If that is the case, that value chain is very long. Now you can understand that value chain can be expanded if you want. Before taking decision, whatever the decision, you need to understand who you are, what industry you are in, and what kind of value chains that you are facing, and the possibilities for you to expand the value chain. It's you. If you decide, no, I don't want to be with very lengthy value chain, I would like to just farm something by myself, and those producers can be taken for my own consumption. If there is an excess, I can just sell it to sell it them at the whatever the fair, or maybe in a particular boutique. That's your value chain. Then you need not to think of big strategies. There would not be big competitors because you are not doing any that kind of competition. The competition may come within your country or maybe from international. So nowadays, competition, so even the oligarchies, the monopolies are created, some kind of competition can be seen when you see the trading between countries, even between countries now. Say when we take China, Japan, India, USA, though they fight each other to have a bigger share in the world economy, of course, they have their own alliances, Right. Then the business logics, operating capabilities. Again, I would like to explain a little bit these capabilities. Some of these capabilities can be identified and measured and explicitly explained whether you can do that or this, especially when it comes to production. Some of the capabilities cannot be seen, especially when it comes to the way of doing things, way of organizing things. That could be the reason why in the innovation, in the business innovation, I'm not sure whether you have taken this kind of subject or not. Uh, in addition to product innovation, nowadays, what really creates lots of value are process innovation. Processes, if you can simplify them, if you can modify them, or in such a manner that create or generate more value with low cost. So it's your operating capability. Of course, operating capability does not happen without having any resources. You need to have resources. That means your assets and your competencies as well. Competencies, of course, include your knowledge, learning, and abilities. Together would be your competencies. So these things are seen not only with respect to individuals, with respect to organizations as well. Organizations also have their own learning, organizational culture, ways of doing things. So that is the organizational value. That could be the reason why when we consider a value of a firm as a whole, that is normally greater than the summation of the values of total assets minus liabilities. Even if you measure them at the fair values, the value as a whole is much greater than the summation of the values. That is the reason. Then the relevance of shareholder value maximization. So this is in a way very old concept. but unfortunately we have to use it. This value maximization links to Adam Smith utility maximization concept. Big question is there now. Again, maximization has no limit. That is why now whenever you think of value maximization towards the end, you simply disregard the other things because your objective is maximize. But what is the maximization? There's no maximum limit. Limit is in the sky. So that you engage even in unethical practices, unsustainable things. You are ready to destroy the environment. You do not care about the climate change issues. You do not care about the social unrest or the inequality on income distribution. No worries, because you try to maximize. Because when you maximize wealth, shareholders would get more profits. However, it is considered, though it is considered as a fact, kind of modifications have been introduced to this value maximization strategy. It should be integrated with sustainability, ethical business conduct, climate change issues, so-called things are there you may have learned, but it's good if you can combine all those things. There is no use of learning value maximization separately, simply disregarding all the other things, and you become a greedy person and just amazing wealth at any cost. But at the same time, you learn separate subject called business ethics and sustainability. So that is separate from this. No, it should be combined. However, in the pursuit of maximizing value, you need to have your own corporate vision, and to reach that vision, I mean, based on that particular vision, you have to have a mission. That through that particular mission, you achieve some objectives. To achieve the objectives, you need to have strategies. And so when you implement those strategies, you operationalize drivers, so-called business drivers, which generate value. So this is how they are connected, interconnected to each other. So the drivers then links to the value, that the loop continues like that. Then managers' conviction and commitment to deliver shareholders value in the long run. I mean, it's rather theoretical explanation only. Then we believe and we argue that managers in bona fide work day and night by using their competencies, talents, and everything to earn profits for shareholders. No, it's not. Lots of things are happening. So managers would try to maximize their own interests at the expense of shareholders' wealth. So this would lead to conflict of interest as well. We have some solution as well, but basically, when we talk about strategic value analysis, of course, this value creation or the value generation cannot be achieved unless managers are ready to work in bona fide to maximize the value for shareholders. That's the idea. Strategic value analysis, then the prospering and retaining competitiveness. You see, so this has a relevance only and only when we engage in operation with a competitive context environment, not otherwise. So whereby if you have your strategies, of course, your competitiveness can be increased. If you are interested in reading, just you can read Michael Porter's 5 forces model, the generic value creation. You would get some insight of these things. However, that belonged to 1980s, a long time back. The relevance of these things nowadays is heavily questioned. If you really want to learn more in detail, read Michael Porter's the competitiveness and strategic what you call the position of a firm. upholding vigor and the agility even in adverse business environment. So if you are in strategic value for your business processes, your firm is well connected to a strategic value chain, you must be able to resist to any situation. In other words, you should be resilient. Vigor and agility should be there. Quick flexibility should be there. Of course, because of the technology, especially in heavy manufacturing, flexible manufacturing, um, total quality management, and so many new concepts have enabled firms to be agile and firms to be more resilient, of course. But when some adverse things happen, your agility, your resilience, or your position is questioned, and it reveals. Good example is the COVID, the impact of COVID pandemic. When in a global scenario, global situation, it doesn't mean that every company faced the, of course, to some extent, the physical movements, mobilization was restricted, whereby corporations are curtailed. But since we live in technology era, you could have used the technology to some extent to manage this, not only by the corporate, private corporation, even by the government entities, could have intervened easily to distribute goods and services, especially at least essential things. So what we experienced in Sri Lanka was the worst, I suppose. Even now, so big companies, those who engage or sell their goods and services by using online platforms, do not provide efficient services. They use all those platforms to maximize their benefits, so maximize their profits, not to provide efficient and effective services. So it's critical and problematic. You can think of doing a particular research. Maybe I do not know whether you have already started doing your research. If you have started doing your research, please think of questioning the engagement of our businesses, especially during this pandemic period. So interrogate them, how best they took into account social responsibilities and humanities and the other things from ethical conduct, whether they were able to do so or whether they tried to maximize their own profits. If you just think of other big companies, everyone tried to earn quick bucks. They didn't want to have solution from collective efforts. The maintenance of business growth and generation of free cash flows. Of course, in the strategic value analysis, without having a growth, possibilities of enhancing value would be very less. Without having a growth, you just simply maintain the status quo. If you simply maintain the status quo over time, what happens? Your financial capital goes down. Financial capital goes down because of inflation, and even your physical. So sometimes, so you may maintain the financial capital, but the physical capital, of course, will go down. So you will not be able to produce the same amount of goods and services with the same amount of money. Assume that you had 5 million or 100 million rupees. After 20 years, you have still 100 million rupees. Therefore, still you have maintained financial capital. But with 100 million rupees after 20 years, could not do the things that you did 20 years before. The physical capacity has not been maintained. So if that, so that implies that such a business could not last for long. Within a short period of time, maybe going concern could be questioned and it would collapse. That's number one. So therefore, growth matters. How do you ensure the growth? So in order to ensure the growth, you need to have adequate investment, re-engineering business processes. You need to realign your strategic value analysis depending on new changes in the businesses. So therefore, Strategic value analysis discussion is not simple discussion that could be done in isolation. It has to be done in connection with other things, whereas business growth plays a very important role in that regard. Generation of free cash flows. I'm not sure whether you have learned about the free cash flow. Have you just learned finance? Of course, yes. Simply speaking, free cash flow is the cash flow available for the managers to freely deal with lenders and owners. To freely deal with lenders and owners. How do you freely deal with lenders and owners? If you have a free cash flow, you can freely invest somewhere, or you can get it from existing borrowing. You can lend or borrow. You can pay your interest. Then you are free. In order to do that, you have to have some money. Therefore, free cash flow means the cash flows generated from your operating activities, from your operations, that is the profit in a way, reflected in cash flows on cash basis. That could be used, but before you use it freely, you have an obligation. What is the obligation? That obligation is connected to the business growth. Before moving towards the free cash flow, you need to ensure that the business would maintain its capacity. That is why you need to have a growth. In order to have a growth, you need to reinvest. You need to leave some money, set aside some money. That is where you invest in assets. Set aside some money for investing activities. Investing in the sense, not just buying shares or other things or financial assets, just to invest in the business, more new businesses, expansion, acquisition of companies, new operations, new businesses, or whatever it is. That is what we call reinvestment of the profits. Once you have done it, now you are free. You do it in an appropriate manner, which is suitable for your company. You know your capacity. You earn 100 million. So with the capacity, experience, learning, potential, your competencies, even business opportunities that exist within the country, outside, government policies, once you come taken into account all those scenarios, you know that out of this 100 million, I can utilize only 60 effectively. If I try to reinvest entire 100, so it would be counterproductive. I will not be able to obtain attractive returns. So this is my maximum limit, that is 60. So therefore, that is for reinvestment. Then there's a balance of 40. That 40 is your free cash flow. Then you decide either to lend or to release or redeem your debt. That is number one. If you do not have such, if you do not have any involvement with the debt holders, just turn to shareholders. So give this 40 million back as dividends, or you can repurchase shares. I want you to go to Colombo Stock Exchange website and study recent proposal given by Ceylon Investment PLC and Ceylon Investment, Ceylon Guardian Investment Trust. Two companies utilize, not yet, so proposed to utilize its funds amounting, Ceylon PLC amounting to almost 100 million, Guardian Investment maybe 90 million something, relatively a significant amount of cash, not as dividends, not as dividends. Very interesting move. Instead of paying dividends, had they paid dividends, so dividend would be very trivial. With the presence of that business, actually Ceylon PLC used to paying relatively high dividends. Now they could not. But with the limited amount of money that it has, it opted to repurchase its own shares. Therefore, free cash flow of 102 million is going to be used to repurchase. Read that particular corporate announcement. You find interesting. I'll just give you very brief of. Currently, for example, I'll take only one company, Ceylon Investment PLC. Currently, a share is traded on the Colombo Stock Exchange at a price around 53, 50 to 55. But they are going to repurchase a share at a price of 102, almost double. Very attractive price. So if you have shares in Ceylon Investment PLC now, you can sell them back to the company at 102 once the date is announced later on. So you can have 100% profit. But again, there's another question. Not all the shares that you hold will be bought by them. They buy only 1 out of 102 shares. So only 1/100th of shares would be repurchased. It's a very strategic move. You better do the calculation about these prices, X repurchase price and the current market price and business valuation. As of now, it's net assets and earnings per share. Take those things into account and come out with a kind of valuation, because the end objective of today's strategic value analysis would end up with the corporate valuation. Corporate valuation is done with share valuation. How are we going to value it? So that is a good example. Please read it. Next week, I will, anyway, though I say that I will ask questions, so you guys are silent. Can't help. That is not my fault. It's a bit unfortunate situation. Right. Then with that, if you carefully deal with free cash flow, either to engage with lenders and equity holders, you show kind of efficient business practices. You are considered to be good, as a good team of managers. If that happens, your value creation really takes place in a sustainable manner over the longer period of time. Long-term value creation can be seen only and only if that strategic value analysis and the materialization take place. Why does a firm have to assess its value? You may ask this simple question. Do we need to value the firm or value the shares? And should we worry about the value generation within the firm? Because, against this argument, some may say no need. Why? You generate value as long as shareholders are happy, you give decent return, the share prices go up, and market is always in a momentum. If you can maintain a growth momentum and all this, that's all right. But we do not know, because these kind of things can happen even without having a value generation. So that is the danger. Due to business dynamics or any other reasons, sometimes you may experience some cycles, business cycles, or the good time and bad times. If your good time is perceived as something you have been doing things right, everything right, you may not know what is really happening. At the end of that particular time period, disaster, you would follow the disaster. So that is why you need to have these checks and balances in that regard. Assessing the value of your firm will help you to do certain things. There could be many uses. Number one use, even for financing purposes. If you know the real value of your business, you can negotiate with lenders for better terms, depending on your credit worthiness. Take the example of Sri Lanka. So its value, the credit worthiness has gone down. International credit rating agencies have downgraded up to CC, right? From CC plus position, now it is CC. So almost at the default, verge of default stage. It's more dangerous. Therefore, at least you know it. knowing this, you have to decide that no, you should not go for new borrowing, because if you think of new borrowing, your cost of borrowing would be very high. But if you know you are financially stable, your credit worthiness very high, you can decide whether you should go for new borrowing, or if that's the case, at what price, or should you turn to shareholders and ask for more money through either private placement or right issue or any other things, or whatever. If you have excess, should it be distributed as dividends or whatever? So you can understand that the assessing the value of the firm will help you deal with financing purposes and investment purposes also. Even though you like and you want to expand the businesses, you want to have a very high growth rate. In order to achieve that particular growth rate, you need to have this much capacity, capabilities. In order to have that much capacity, you need to have resource allocation is needed. How do you get these resources? You need to have money, right? So if adequate money has not been generated, your investment proposals could be in jeopardized. So that is the reason why you need to think of your assessment. So investment purposes also, we need to do this, the valuation. And a general health check is the ordinary statement. Of course, it is always good to know what status that you maintain in terms of your financial position. Of course, your financial position, because when we take the financial position, financial performance is already embedded in the financial position. If your financial position is strong, of course, your general health is good. Now, when it comes to valuation, what are we going to value? Current value or future value? There are two arguments. We need, because what we exactly certainly know is the current value and not the future value. So should we go for the current value? What does the balance sheet show you? The current value, of course. But some of the values are shown at the historical values as well. So that's why accounting standards, in a way, always encourage and provide room for the managers to use the current value whenever it is necessary and applicable. Of course, current value tells you something. Current value can be ascertained, but business valuation goes beyond the current value. Current value is the ability, your potential, the capabilities of an entity to generate future economic benefits. How best those things would be generated in the future depends on your structure, your strategies, your vision, mission, and all those things, and how they are put into practice. Subject to other changes, of course, environmental changes, government policies, international, some of the things that we could not control, such as pandemic, like COVID, natural hazards, there could be so many things. So however it is, there is a connection between future value and the current value. Of course, we anchor on the current value. Based on the current value, we assess the future value generation, and again, we bring it back to the present situation in terms of present value. So therefore, this value is a combination, but rather futuristic orientation is there, because what has happened already, I can't say that that is not important, would be less relevant for decision making. The future, what's going to happen in the future, might link to decisions at the end of the day. Then consider only financial statement analysis or other information, including industry analysis as well. Traditionally, when we analyze the value chain or the financial health of a company, even we have a separate subject called financial statement analysis, where you may have learned ratio analysis, which are calculated based on the numbers given on financial statements, and say that and this. We talk about profitability, we talk about efficiency, we talk about liquidity, we talk about solvency, we talk about its market performance, likewise, so on and so forth. But the business realities do not limit to the numbers shown in the financial statements, especially when it comes to um, value chain analysis, strategic value analysis. You need to go beyond the numbers. In other words, we are supposed to analyze the realities behind numbers. Realities behind numbers. Numbers reflect only that part of values which could be measured in terms of finance and with lots of limitations. So that's why in under normal financial statement analysis or any other analysis, we can limit our discussion to financial statement or the numbers given in the financial statements. But here we need to go beyond that. Then another question can be raised. Does the book value reflect the value of a firm? It really depends. Of course, even to some extent, it would not be the complete value. Again, you may argue, no, if we can reinstate all the values at their fair values, then you may say that yes, book value of a firm would reflect its real value. But remember, I just told you, that is the current value as of now. Business valuation or strategic value analysis goes beyond that. There could be something which cannot be measured in terms of assets and liabilities, but embedded in the businesses. That is missing if you think of even fair book values. And the values that could have been incorporated or taken into account, which would arise from environmental factors and non-financial things are not there in the book value. So therefore, book value can be taken as a proxy for part of it and not purely as the value. Need for strategic approach valuation. That's why we need to think of strategic valuation. Hence, I can summarize strategic valuation takes into account both current values, future values, business environment, policies, and other surrounding capabilities, skills of managers or the human capital of the entities, government policies, global scenarios, technological development, so on and so forth. So many things are there because you can't simply ignore any single variable or dimension. Why? Businesses cannot be carried out, or the firms do not operate in isolation in a separate context. So it operates it interacts with the society, it interacts with the environment, it interacts with the human. So therefore, it has to take into account everything. That approach is called strategic approach of valuation. Historical valuation, I think need not to explain much already. I explain most of the things. The difference between historical valuation and strategic valuation. Then the historical or the traditional approach simply explain what it is, but the strategic analysis, of course, use them and takes into account future as well. So that is how it deviates from the historical or the traditional valuation. If you look at the historical valuation, it foregoes the chance to review internal and external forces, impact of internal and external forces. For example, the impact of COVID, and again, if you take into account global business recessions nowadays, and bad experiences that other countries also face, even the United States. And good example, if you are interested in, you better study about the Turkey. Nowadays, Turkey is experiencing huge crisis. I don't know whether you guys have come across within like last week, the inflation in Turkey is skyrocketing, whereas the currency called lira, Turkish lira, is heavily depreciated more than 50%, I suppose, and facing heavy economic consequences, mainly due to adamant and ill-fated financial policies that they used. Financial policies that they used. So see exactly similar policies like us. So in Sri Lanka, even as of now, control the interest rate with the fear of increase in forward exchange rates in the country. You know that foreign exchange rate is somewhere around 203. It is controlled. You can control it if you have adequate foreign reserves. Country does not have adequate foreign reserves, but tries to control it just to face this particular situation. Otherwise, inflation goes up with that fear. No, you can't. You need to release it. Otherwise, the country will have to face severe consequences of inflation. Maybe we do not know the time. It's a matter of time. 1 month, 2 months, 6 months, 1 year. I do not know. But like in the case of Turkey, yes, of course, we will have to face unless these issues would be arrested. But the way the government approaches and the government intervenes in the things is like something, it's nowhere. Government has simply turned a blind eye to all those issues. They think of themselves and highly short-sighted, short profit maximization, and thinking of themselves and the cronies and close political aides and their companions only, not the masses. You better study this. Sometimes even in the examination that would be helpful. Of course, if a question comes from this area, if I will be asked to set a question, it will not be, I mean, you will never be tested something to buy hard, what is strategic value chain analysis, so no way. I'm not asking any of these things. I'm not asking any of these things seen in the slide. I'm asking something connected to a practical situation. Businesses, you need to learn it. That is what you need to come out with the kind of innovative, creative ideas, because there is no point. So in that regard, I request you to read what's happening in Turkey as of now. Sri Lanka also controlled the interest rate. Even now it has been controlled. For over 2 years, deposit rate and the facility rates were 5% and 4% and 5%, and it was released. Even it was increased up to 5 to 6. It has not been freely allowed to float because the government cannot borrow at very high rates because of huge budget deficit, wrong economic policies and finance policies and fiscal policies. Government, of course, on one hand, government is in trouble. So that is the control situation. Why I am referring to this situation, Turkey also did the same thing, simply disregarded the financial theory, basic fundamentals of financial policies, and that then I can't remember the president's name. That president was a little bit adamant. He said, no worries. Like our guy said, modern monetary theory can be used. He said, no worries. Just adopted unorthodox policy of controlling interest rates. Now, situation has really burst. Okay. What I just wanted to highlight here is strategic value analysis should take into account everything. Again, I talked about the sustainability as well, society as well, and the traditional approach fails to identify business drivers behind the financial statements. So that is the biggest problem with the traditional approach that takes into account numbers given in the financial statement. So what really drives value is simply ignored. There could be so many value drivers. There could be some operations which may not add values, generate values. So value adding activities are important. So that is the analysis. Why are we doing this thing? In order to identify in the first place value adding activities and non-value adding activities. The non-value adding activities, you should take strategies to convert them into value adding. Or not, if not, you need to get rid from those non-value adding activities. And whenever you have value adding activities, you need to further uh, enhance value adding activities in such a manner to create value on consistent basis. Now, we will discuss the connection of value chains, value drivers, and strategic drivers. So value chain can be identified. So now don't by heart or try to just read or define uh, the value chain by using formal words given. Try to understand the value chain in the way that I explain you, right? Just go back to the meaning of value. That is the basically intrinsic value created, embedded in that good or service. Therefore, value, the amount of value depends on the nature of the product, processes of the product, length of the product, operating cycle. Likewise, there are so many things you can take into account. If that operating cycle, the complexity is very insignificant, very straightforward, then the value chain is very short. Otherwise, value chain can go up to a global context. That is how it is. So value chain is a step-by-step business model for transforming product or services from ideas to realities. Now you can see these ideas could be very tiny, small idea or very broad, complex idea. How best we convert them into realities is the question of value chain analysis, no matter whether it is small or big. Value drivers are anything that can be added. Driver is something that creates, that generates, that adds value to the product. So they are value drivers. Value drivers are seen in the business processes. When you sell something, yes, there's a value driver. When you manufacture something at a very efficient cost, there is a value driver. If you do something or in such a manner that would either increase the profit or decrease the cost, that could be a value driver. So therefore, value drivers are actions. The concept of these value drivers was taken in activity-based costing. I hope that you have learned activity-based costing. Activity-based costing is followed by activity-based management. Really take into account value drivers. It is good to connect all those things. Actually, if you can develop such a way of learning, it is easy for you. Connect, no matter whether you learn finance, accounting, strategic management, accounting, marketing, actually they are connected to one course, a pursuit of producing goods and services. At the end of the day, all sort of things are nothing but the mode of production. How the production takes place is the subject in business management, no matter what degree that you do. So that holistic approach really helps you to dig into the things and question things rather than by heart. So strategic drivers are forces that shape organization strategy. So to see, generally, even without having strategies, value creation can take place. But if you let the value creation or value generation happen in that way, lots of problems may be created. Your competitors may take over your businesses. You will not be able to sustain it for a longer period of time. You would not be resilient. You would not be able to face unexpected situations. So that is the problem unless you have strategic drivers. So that is why we introduce the word strategy. So when we have strategic value drivers, of course, they should be linked to your strategies, corporate strategies, and the strategic vision, mission, objectives, and the connection really matter. Therefore, strategies are shaped by both external and internal forces. Again, got to be very careful about this particular meaning I just told you. Strategy can be used even with ugly meaning, right? So that is what, like, it is a presumption that we use the strategy with ethical meaning. Strategy can be used with unethical meaning. Um, some of the products, or some, when competition comes into the market, the giant company, that is how the monopolies are created, and the competition can be destroyed. Big company which has the influence in the market, when a new comer enters into the market, what can they do? They can buy all their products and destroy. So this happened long time back between Coca-Cola and Pepsi. They had a kind of battle of destroying glass bottles, sometimes sort of unethical practices. So unethical practices can be seen in businesses, in profession, even individual behaviors, but they justify. If you destroy your enemy, your competitor, it is your strategy because you want to maximize your own profit. Therefore, if you destroy the bottles, containers, or do something undercutting or headhunting by paying that and this, or killing others, then always you can justify. Why? Because you do the best, do something with the best interest of your something that you got. Remember the recent incident that took place in Pakistan. One Sri Lankan called Priyanta was killed, and just burnt by a mob of 200, 300 people. How did they do that? It was not an accident, no matter whether who is accused and what kind of things really caused that incident to happen. It's not something that happened just because of provocation or any other things, because the belief that within that particular mob or the community who believes strong in their religion, culture, or any other thing, this person has been recognized as an intruder. So that is the reason why, if you have just killed someone by mistake, or maybe because of the provocation, once you have killed, you feel worried, and so you try to escape from that place, and even you have your own fear. They did not have, they were enjoying, they were celebrating. Even small kids were taking selfies with the burning body. How come? If you talk to them, they might say, we did the right thing, because he is an enemy to our whatever, the world that they have created. So that's what I just told you. When the individual maximization is promoted, no matter whether it is a society or religion, individual, businesses, country, lots of bad things can happen. It will go beyond ethical practices, totally unethical, unacceptable things can happen. Even now in businesses, lots of unethical things are happening. That is the reason why, even with this pandemic situation, Sri Lankan businesses, together with the support, with the government support, and can sell oil, coconut oil, adulterated with kind of chemicals. I can't remember that the chemical. Even adulterated the sugar, coconut oil, or any other product, even the gas, right? No matter whether innocent consumers or household would get killed because of bursts, they think of the profit. Now you can understand the disasters and the ugly phases of this profit maximization and unethical practices, unless you have a very good foundation, good governance and ethics and all those things. That is why you have to learn strategies very carefully. Otherwise, you would justify any action that you do as a strategy. But for this subject, not only for this subject, for your social behavior as a human, I always encourage and promote you to be ethical and understand and learn these things with that broader humanistic and societal point of view, not only from the profit motive, because that is a bit dangerous. So this is the analysis. So analysis would take into account the drivers for strategic drivers. Actually, strategic drivers are connected with the company's abilities, like how many patents. You know that lots of pharmaceutical companies and IT giants, they have patent rights. So patent rights, license, and any other monopolies are strategic drivers. Ceylon tobacco has lots of strategic drivers because others cannot manufacture cigarettes actually. So they have that is the only company which has the license to manufacture. So I mean that is a very extreme example. So likewise, you can think of these kind of capabilities gained by acquired by companies. They are called strategic drivers. Value drivers are the actions. Even tobacco has the license. So if the Ceylon tobacco does not manufacture and sell them, then the value mechanism does not activate. Even like say license is there, government imposes huge tax just to discourage smoking. Prices would be increased by 100 rupees. Then they can't keep the production machine running. Then the value drivers do not activate, even though strategic drivers are there. Key strategies and assumptions. So when you go for valuation, we have to identify key strategies, and sometimes we may have to make some assumptions. This will happen and this will not happen. This would be the situation. This kind of capacity would be there. Likewise, so many things we'll have to take into account. Then you have your strategic plan. So once you take into account strategic drivers, value drivers, assumptions, strategies, and the plan, we call strategic analysis and planning stage. We are identification and formulation part. So this, based on this, we need to go for the valuation. So valuation, of course, see, though we have so many different ways of assessing the value of a firm for value generation, for this particular subject, we use only discounted cash flow technique as a tool, since that is considered to be relatively objective and can estimate with less flaws. I don't say that that is perfect. Discounted cash flow techniques it has its own weaknesses. So stages already that is there. So that the value drivers are within the businesses, so the conduct of businesses may be embedded in the brand, product, sale network, customers, work team, organization, corporate culture, technology that you have. So many things would be your value drivers. Value drivers may be there, value is generated once you put the drivers into action. Strategic drivers are patents, license, and any other capabilities, organizational capabilities and competencies. So this is where new thing I call normally organizations have their capabilities and competencies in terms of licenses, patents, and other learning curves, or the arrangement, organizational cultures. In addition, there is another thing, unique thing, which has been discussed in the recent past, that is called orgaware. Orgaware is the abilities, in a way, competencies of an organization to do things in different ways, way of organizing. That's not documented anywhere. You don't see it. That's a mental model. We do not know. That's why even with the organizations with the same assets, same physical assets, similar types of employees, similar types of businesses who do differently because of ways of doing, I mean, the differences in ways of doing things. That's what we call orgaware, such as hardware, software, humanware, Ogre is the newest the component. Operational value drivers are connected to the value drivers. Actually, value drivers go hand in hand with operational value drivers. However, value drivers and operational value drivers, or even strategic value drivers, cannot be separately valued reliably. You can ascertain the value to some extent, you can estimate the value, but you need to value together, maybe as separate cash generating units, CGUs, or as separate businesses or separate entities. That is the approach. Holistic, therefore, simply we can say that no matter whether it is that kind of business or cash generating unit or strategic business unit or any other thing, holistic approach that takes synergies should be the approach. Yes, Ogre where is, so someone has just asked a question. Ogre where is a way of organizing things. Way of organizing things cannot be detected easily. It's there, it's embedded in the competencies of managers and the organizational learnings. For example, say organizing your production processes and the way of dealing with your customers, and even arranging your operations. So machines are there, that is physical. How the machines are placed in such a manner that would create the efficiency, that would really motivate employees to engage in production, that would really less the fatigue of employees when they work. Likewise, it really develops by learning. You may have learned about learning curve. This comes as a learning curve. If I relate this to social sciences, take your home, right? Suppose take your bedroom, or maybe the sitting hall. There are some equipment, so TV, settee, chair, and like some equipment should be there, and all these things. How many ways in which you can arrange this? Infinite. What is the best way? You don't know. So you can't just name them. But sometimes you feel whenever you go home after working, your mom or sister or whoever at home, so they are really good at doing these kind of things. They may have rearranged the settings, equipment. Oh, you might say, oh, it looks nice. You feel good. That's over there. But today's arrangement may not be seen tomorrow. So that if you want, you can document, but it's very hard for organization to document it. It comes as a result of own practices. That is what we call overwear. So therefore, in a competitive world, what can create more value is the overwear, because the technology can be bought by everyone, right? And humans. So if you want someone who has the most talents in the world, you can buy. Another company also can buy. But how you work depends on you. How you organize the things, how you deal with customers. Even though you have procedures, way of dealing, what words are used with customers really depends. So that is the meaning of overwear, and lots of research is also there with overwear. Just try to understand, it has lots of meaning. Now value identification, already I can skip this. I can move to this particular triangulation. Now value formulation, that is the planning process. Already I explained you. Vision, mission, and the importance of the objectives, goal, connection. Again, the vision, mission, objective, strategies, objectives, all those things go along with the profit, the concept of profit. If you do not have such motives, actually some of the things could be kept somewhere and you can do something else. Define business logics for the target market. So business logics actually connect to the business models as well. And you know that even you have resources, you have money, employees, business ideas, and all those things. You can't do everything. You need to decide what to do and what they are the basic questions that you have to ask. Basic economic questions. What technology do you have? What products are you to be um, produced, and what goods to be produced, to whom, and how they are distributed, and basic things. So likewise, in economics and business management, we say that that is identification of your target markets and your product. So that is what we call business logic. It doesn't mean that you are going to be limited to that. Later on, you would expand. Whenever you expand, again, you do the same process. The linkage um, of strategies to operation is a must. Sometimes you have fantastic strategies, but when it comes to operations, you do something else based on your own practices and learning that, and this simply disregarding strategies. This is one of the biggest problem that we see in the government or the public sector institutions. They also have their strategies, but due to some other reasons, the politics intervene and they are not allowed to carry out their strategies. Instead, to maintain their operations with the limited amount of public resources or the money allocated through the budget, or maybe with the political motives, you do something else. From maybe somewhere down the line, a minister might ask you, okay, do that, just scrap that, go ahead. So these petty politics can happen, especially in public sector. Even in private sector also, these things can be seen, because you need not to be worried about so many strategies if you are highly opportunistic. If you have contacts with the government, you can easily take commission and just bypass the tender process. So why do you have to have strategies? No need. Your strategy is to maintain these good relationship and pay commissions. This is what happened when they, you see, so another good example, the importation of this chemical fertilizer from Chinese. I'm not referring to that Chinese ship. There is another importation of fertilizer, liquid fertilizer, already imported. Actually, the money that should have been paid to the seller had been deposited in the agent's account in Sri Lanka in dollars, in special account open in people's name. It's a clear violation. But here, when the legal framework is not that strong, you can do anything. You can come out with 101 excuses, and there is no public protest, and public also accept it. As long as you accept, that is your wish. This is nothing but the country that we like, we love. This is how things happen. Okay, so sometimes even in the no matter whether it is public or private, strategies would be somewhere else, actions would be somewhere else. But we are talking about from holistic point of view, it should link each other. Assumption to strategic plan. So assumptions are needed. So up to what capacity would be used, and expansion strategies, and assumption about the future interest rate, market situation, government policies. Likewise, some assumptions may be realistic, some assumptions may not be realistic. That is the leverage that we have to take into account. So that's the risk. So finally, we need to assess the value drivers. These three links can be shown the triangulation or triangular relationship of business drivers. Again, remember, so these are valid only and only when a kind of efficient competition takes place. If that is the case, the competitive advantages of a company or a firm really depends on how best you combine, you really deal with your strategic drivers and value drivers. How best you take them into account, how best you value them, how best you position these strategies would determine your competitive advantage. Up to some extent, if the environment is highly competitive, yes, of course, later on what happens, this competitive environment would lead to monopolies or oligarchies. If that's the case, Still, value drivers and strategic drivers can create value, but you need not to be so much worried about the competitive advantages because you have the power to dominate um, in the market. What represent the value, profit or cash flows? We have a few questions to be asked before winding up for today. I think yes, in 5 minutes time. Cash flows from operations, cash flows from financing, free cash flows. So you better read. I will just take this also up before having the discussion next week. Again, analyze what I meant by the value. Value can be created and can be amassed. Of course, you can name it as creation, but we refer to value creation through real mode of production of goods and services. If that's the case, value cannot come from any other things. Value can come only from your operations, operating activities. Therefore, cash flows from your operations. Therefore, the profit is a proxy of the cash flows measured based on accrual basis. So therefore, profit is a value, nothing to worry. So really, it is embedded in the cash flows from operations. From financing activities, you can't generate value, but mind that there is a point. You can take this for research purposes. Financing activities cannot generate value, but it can boost and it can really influence the return on equity. That is the beauty of financing activities. That is why, that is how the leverage can help improve return on equity and not return on assets. Even if you have borrowed money or your own money, machine works in the same way, same processes. So no matter, so if you just put an argument, so two people just buy two machines, photocopy machines with the same capacity, assuming that both have the same competencies, same hardware, same capabilities, and demand is also there. Just in front of the university, you run businesses. What would be the profitability? Same. I mean, the cash generation would be the same. But in the first scenario, you have invested your own money. It has its own cost of equity. But the second scenario, you have partly borrowed. That there would, if there is a difference between cost of debt and cost of equity, and if the cost of debt is less than the cost of equity, of course, your return would go up in the second scenario. I hope it's clear to you. Don't get it confused. Financing activities cannot generate value, but it could boost and increase the return on equity. So this is where you can research if you want whether financing activities have what would be the influence of financing activities or the borrowing or capital structure on financial performance. That financial performance is not the profit, amount of profit. The financial performance you have to measure in terms of return on equity, not on anything else. So you can compare it. So you can compare, calculate return on equity, and you can calculate return on asset and see whether there is a significant difference between that and this. Of course, that is a result of the capital structure for the borrowing. Free cash flows also do not create any value. Free cash flow is the result of value creation. Value creation comes from cash flows from operation. You set aside something for investment, then the balance is called free cash flows. So free cash flows is a result of value creation, and free cash flows cannot generate value. Why? It is in the form of cash. If you do not use it in appropriate manner, it would rather distract the value. Suppose that you have excess cash of 50,000 or 50 million. Unless you redeem your debtors or invest somewhere else in financial assets, if you keep that money in the form of cash, running cash, what happens? no written at all, that amount would eat out the profits earned by the other sections. That's the meaning. So, but it doesn't mean that we can't take the free cash flow for valuation purposes. You have to do it with understanding, because it's a proxy of the value created, but it does not create value. Here, simply speaking, value creation, the value generation comes only from operation. That is where and why we have to strategically analyze the value chain. So the global level, this value chain can be linked to global value chains, whereby the global supply chain also can be connected. With that, I will conclude for today. Uh, you better go through these things, and if you come out with some questions, I can ask. Even now, if you have any questions or clarification or whatever, I can spare some time. 8:45 there is a presentation for group 40 and group 17. You are free to join if you are interested in. I think some marks are also given for your attendance. You better decide which presentation should you join. I think yes, Dan is calling. But you may raise some question if you have. Right. Do you have any questions? Is someone talking? I see someone, Lakshika, is just appearing. Are you talking? Lakshika? Maybe you may have just clicked the screen. That's why your name is appearing. It seems like there are no questions. I do not see any hands raised. No messages in the chat box. Okay. Okay, Lakshika also says no questions. Thank you so much. Have a nice weekend. And those who celebrate Christmas, I wish you Merry Christmas. So see you next week. But I kindly request you to read the relevant chapter and what's really happening in the business world also. That would be really good for us to continue the discussion. So I would continue from the place where I stopped and connect it to business valuation, and with some alternative value chain models I'm going to discuss. Okay, thank you so much. Good night. Bye-bye.